very different piece of theatre yesterday to what we saw in Helsinki. It's a weekly job now. It's nearly a daily job.
Right.
Give me your latest assessment.
But I mean, I think it's very significant. The reality is that the tariff issue is one of the swords of Damocles hanging over the markets here, right? We have good economic growth in the U.S., and more recently we've actually had better economic indicators in Europe, right? So European GDP looks to be about 0.5% quarter on quarter. And so what's holding back the markets in many respects, particularly the capital markets in fixed income, is this concept that the tariffs are going to be negative for emerging markets, are going to be negative for risk assets. And so any sign that we get, and you saw the euro's reaction, I think, is the simplest way to look at it.
Yes.
Any reaction, any significant step forward we get in moving the tariff situation away focuses the market back on the fundamentals. And as we've been talking about for a long time, and as the Federal Reserve has been mentioning over and over again, fundamentals in Europe and in the U.S. in particular look very good. So I think it's important. The tariffs are really an important issue.
Okay, let's say we get through those, which takes me back sort of 48 hours. I'd be Joseph Cohen at Goldman warning about the bond market. The bond market's going to have a harder time than the stock market. Do you fall into that camp? Do you think that, do you sort of see through, as your base case scenario, we resolve trade wars, things get better, and yields drop, yields move?
Well, I think our major investment thesis, I think, is undisturbed here, which is that you have economic growth at upside surprises. In the U.S., you have fiscal spending, tax cuts. European economic growth continues to be positive. And that central bank policy is methodical, is calm, is reactive in a way that the market expects. And although risk-free rates, treasury rates may continue to rise modestly, that's positive for risk assets. So the kind of the fly in the ointment, if you will, of what we've had recently is the tariff situation. Because we don't know what the impact will be on emerging markets. We don't know what it will be on global trade. And so if you move that out of the way, you go back to that central regime analysis, which is economic growth is strong, central bank policy reaction is understood by the markets and is methodical, and bang, that's good for risk assets.